Thank you, Shogji. Hello, everyone. Good morning. Let's wait for a minute or two before we can start so that whoever is still in the process of joining can join in, and then we'll start. Let's wait for a minute. I hope studies are going good for everybody and you are all revising uh, the things after the classes. Okay, so let's start. Again, a very warm welcome to everybody and good morning. So, we were in the mid of India's 33, which we have started in our previous section, earning per share, right? So, let me quickly rewind whatever we have discussed and then we will take it forward for the day. So when we started with India's 33, we understood what is the objective and the core principle of the standard, right? So this standard, equips, investors with the better information about the profitability measures, right? So how much a company is earning per share, right? For a shareholder, that is the picture clearly evident by this KPI, right? And this helps investors to compare the company's performance over the periods, the same company performance over the multiple periods or multiple years, and as well as one company's performance with respect to its peer companies, right, within the same sector, right? So that's what is the objective, right? And then we have understood the scope. So as per the scope, EPS disclosure is mandatory for all those companies who are preparing the financial statements under INDES, right? So that's what we have discussed previously. Right. And then we have understood the definitions. Ordinary share. What do you mean by the ordinary share? What do you mean by the potential ordinary shares? Right. So ordinary shares are those shares which have the residual interest in the company. So basically, equity shares is a equity shareholders have the residual interest in the company's assets after paying off all the liabilities, and ordinary share is the share which participates in the last order in all those assets, right? Then potential ordinary shares are those shares which are not yet in issue as of now, but they are expected to be issued in future, right? For example, any convertible bonds, any convertible debentures, convertible preference shares, options, warrants. So all these things, we have discussed in our previous session, right? And then we have understood what is the meaning of dilution and anti-dilution, right? Because EPS measure is divided into two categories. First is the basic earning per share, and second is the diluted earning per share, right? So in the last session, we have done the calculation of basic earning per share. Today, the target is to understand the diluted earning per share, right? And do some numericals around that, right? Then how the EPS is measured. So EPS is measured from continuing operations, from discontinuing operations, and then for net earnings, right? So these are the three, basic EPS and three diluted EPS. In case a company is having both type of operations, continuing as well as discontinued operations, right? Then we have understood what a numerator means, what a denominator means for the purpose of calculation of the basic earning per share, right? So numerator means the profit as per the P&L account plus minus certain adjustments, right? And then denominator is not the closing number of shares, but the weighted average number of shares which were outstanding during the year, right? And the weights needs to be applied basis on the number of days for which the shares were outstanding. And the key thing which we have noticed while doing the numericals is that in case a company does the buyback, right? So in case of buyback, shares are deducted, right? Because those shares are bought back, they are no more in issue, right, by the company, right? Or they are no more in the hands of the shareholders, right? So instead of doing the addition, we should be always, deducting whatever is the weighted average number of bought back shares during the period, right? Then for the numerator, all the adjustments for any preference dividend or any other similar items needs to be done post tax, right? After tax effect of the dividends needs to be adjusted for the purpose of calculation of earnings attributable to equity shareholders, right? And whenever I say earnings attributable to equity shareholders is calculated by doing all these adjustments. So these adjustments I already mentioned in my previous session that we are not going to take into consideration these adjustments for the purpose of our financial statements, right? All these adjustments are just done for the purpose of calculation of earning per share, right? So they are not going to be affecting our financial statements anyway, right? And then we have understood that there could be different scenarios under which company can give pass on some benefits to the preference shareholders, right? uh, and all those benefits, whether the shares were issued at discount at the origination or are being redeemed at a premium at the time of maturity or are being converted at favorable terms as compared to what has been agreed initially as per the shareholders agreement. So whatever is the nature of benefit, we will call it as at the cost of the equity shareholder, right? So whatever is being offered to the preference shareholders is at the cost of equity shareholders. That's why we discussed that whatever is being offered to preference shareholders, right, will be adjusted from the earnings available to equity shareholders, right? So numerator portion, right? And denominator portion always should be the weighted average number of shares, right? So all this stuff we have discussed, and then we did some practicals around this, right? So all these practicals we have done in the last session. And on this example, another key learning we learned is there are two approaches to calculate the weighted average number of shares, and I have explained both the approaches, and I suggested to opt for the second one, right, instead of the first one, because in the first approach we are calculating the number of shares for the partial period, right? So every time calculating the partial period is difficult, right? As well as the number of shares also needs to be adjusted, right? So this approach is more prone to errors, while the second approach is a simpler version to reach the same outcome, right? So this is what we have discussed. And then we have lastly discussed the treasury shares, right? So treasury shares means the shares which have been bought back by the company during the year and are available for retirement or resale. Retirement means cancellation or resale if company wants to offload those shares back to the market, right, or back to the shareholders. So this can be decided as a future course of action. But anyway, as of now, these shares which have been bought back by the company are sitting with the treasury department, right, of the company, right, as investment, right? So they are not yet cancelled or retired and also not yet offered to any investors, right? So the until then, these are treasury shares, right? So that's what we have discussed. Any questions during your homework or during your revision you came up with, or any queries, you may please ask. I'm happy to answer. No questions? Perfect. Okay. Now we will understand what is the bonus issue, what is the stock split, right? I hope you must have heard, the stock split. So bonus issue, everybody knows. Still, I will discuss, but let me pick up the stock split first. So, what do you mean by the stock split? Anybody?
An existing equity share is divided into two shares.
Mhm. So I hope you must have been hearing some news about various companies, right, doing the stock split. For example, Eicher Motors, a year back, they have splitted the share of face value of rupees 10 each into my 1 each, right? So suppose Mr. A, who was holding, say, 50 shares initially of the company, now his 50 shares will be converted into how much? 500 shares, right? This is called the stock split. So stock split means whenever the face value of a stock is reduced and correspondingly the number of shares are increased, right? So issue of new shares with the proportionate reduction in the par value. These are treated similar to the bonus issue because it is not going to impact anything. Neither the company is receiving any share application money or the funds from the shareholders, nor the company is paying anything to the shareholders, right, in the form of any benefits. What the company is simply doing, they are simply increasing the number of shares and reducing the face value of the share, right? So share capital remains intact. For example, initially, suppose company had 5,000 shares of rupees 10 each. So total share capital was how much? 50,000. And now the company has 50,000 shares of rupees 1 each. So again, the total share capital remains intact, right? So this is how the stock split happens. Clear? Right? And any shareholder who was holding, company shares will be entitled to receive additional shares, right? Now, the question arises if the shareholder is getting, say, more shares. So earlier he used to hold 50 shares. Now he will be receiving 450 more shares. So total shares will be 500. So doesn't he gain because share price in the market was quoted for a 50 shares? No. So if the company is listed, the share price in the market or on the exchange, NSE, BSE gets also adjusted very same day, right? And that date is called, what is the terminology we use for that?
Record it.
Record date, right? So record date is the date on which these adjustments take place in the uh, share market or on exchanges in terms of the price, right? So record date could be for anything, for rights issue, for bonus issue, right? For dividends, right? Or for stock split, right? So any action, any corporate action which is taken place in the company has its a record date, and on that record date the share price in the market means on the stock exchanges like NSE, BSE gets adjusted to this corporate action. So that date is called the record date. So any shareholder holding shares on the record date will be benefited, and if a person does the transaction on the record date, he will not be benefited for these corporate actions, or he will not be affected for these corporate actions, right? So record date is the date on which share price gets adjusted on the exchanges, right? So this is the stock split, right? And then the standard says for the purpose of calculation of earning per share, these are treated similar to the bonus issue, right? So that's what the standard is saying, that for the purpose of calculation of earning per share, how you will be taking the effect of stock split in calculation of weighted average number of shares. That's the question arises now, right? So we understood what stock split means, but how this is going to impact the denominator of my EPS calculation, that is the weighted average number of shares, right? Now that question, arises because earlier I was having 5,000 as the opening shares, and on the closing date I have the 50,000 shares, right? So it means 45,000 shares are issued on some particular date. For example, the record date was 1st of October, right? Right? And we are preparing the financials for 31st March 2025, and we are calculating the EPS for March 25. Then how this adjustments needs to take care while calculating the weighted average number of shares. So standard says stock split is treated similar to the bonus issue. And for bonus issue, we know that they are always adjusted from which date? The reporting date, the date on which bonus issue was issued, or from the date inception.
From the date of
Inception, right? So what inception means? So inception means if the company is presenting financial statements, say for 2025, and the comparative numbers are presented for 2024, then for 2025 it will be considered from first day, right? That is 1st of April 24. And for 2024 it will also be adjusted considering it was there on 1st of April 23, right? So prior year EPS is also restated, correct? Yes or no?
Yes.
Right? So same effect we need to give to the stock split as well, right? So there is no difference between the bonus issue and the stock split from the standpoint of the adjustment to the denominator for the purpose of calculation of EPS or DEPS, right? So that's what the standard is saying. So bonus issue, these are treated as if the new shares have been in issue for the whole of the period, right? So no date we need to use for the purpose of calculation of the weight of the bonus issue. Bonus issue is always considered from the day one, right? For the period for which we are computing the EPS, right? So there is a stock split. What if the company is having a, say, 50,000 shares of rupees 1 each, and then they changed or consolidate into 5,000 shares of rupees 10 each? Is it possible or not possible? Reverse stock split or
Yes,
consolidate?
possible.
Possible?
Possible. Yes.
Possible. So company can do anything. So company can do the stock split, as well as company can do the reverse stock split, which is called consolidation of the stock, right? So they can also do the consolidation. Now, will your answer be different for the purpose of calculation of the denominator for our EPS calculation for this consolidation? Or will it be same? That is treated similar to the bonus issue, or treated similar to the stock split? What do you think?
Number of shares will change.
Mm-hmm. So my question is, we have understood that stock split needs to be adjusted the same way the bonus issue has been adjusted for the purpose of calculation of the weighted average number of shares, right? So what does that mean? That means like we used to adjust the bonus issue from the inception date, stock split will also be adjusted from the inception date, right? So no weight calculation needs to be done. Now my question is, in case company does the reverse stock split, in that case the same rule continues to play, or will there be a different, adjustment?
I think it would be same.
Mm-hmm. Others? So it will be same, right? So it doesn't matter whether the company is doing the stock split or the reverse stock split. It doesn't affect, the calculation. So it is always considered from the uh, inception date or for the whole of the period, right?
Date of inception.
Correct. So in case in the examination, by any chance, instead of practical, you receive a theoretical, you know, question by any chance, then what would be the word you would be using? Would you be using the word in from the inception date, or you would be using the word whole of the period? So whole of the period is the appropriate word, right? So instead of calling it that bonus issue, stock split, or consolidation will be adjusted from the inception date, that is for our easy understanding, right? But in case we are going to present our answer, then we should be using the professional wordings which the standard uses. So standard says for whole of the period, right? Whole of the period covers all the aspects. For example, if the company is preparing a quarterly financial, then it means for the whole quarter. If company is presenting half year financials, for the whole half year. If the company is preparing annual financials, then whole of the year, right? So whole of the period should be the word we should start, using, right? To mention the adjustment about bonus issue, stock split, or consolidation. Is that clear?
Clear.
Perfect. So let's do this question. X Limited issued on first of so first on 1st of January, the shares are how much? 10 lakh shares in issue. On 28th of February, issued 2 lakh shares at fair value. On 31st August, bonus issue, one for every three. And then on 30th November, issued 2 lakh 50,000 at fair value. Calculate the number of shares which would be used in the calculation of earning per share. Consider the reporting date as December end, right? So this is your question. I'm giving you 5 minutes. Please try to come up with your answers. So we need to calculate the denominator. That is the weighted average number of shares.
1588,904.
Sorry, what's your answer?
1588,904.
Okay. Others? I hope everybody is trying instead of waiting for the solution.
13,39,727.
Okay. Others? Any other answer before I discuss the calculation? Okay. So let's see. So for 1st of January to 28th of February, how many shares are in issue? For the full month, divide by 12. So if you are doing the number of days or for the number of months, it hardly impacts, in single digit, right? So because in this question, dates are somewhat consistent that instead of going by the number of days, we give the number of months as well. So that's why the suggested solution by institute is on the number of months. But even if you have done the calculation on the number of days, it will hardly, impact your overall answer, right? Max by a single digit. It will not be affecting, right? But still always prefer to give answer basis on the number of days. But let's understand. So for 2 months, it is outstanding, divide by the total 12 months into my 4 by 3. What does this 4 by 3 is? Any idea? You giving a 4 by 3 to this number of shares? No idea. So we bonus share, one share every, right? So eventually, what does this mean? This means shares will be translated into 4 shares. Correct or not? If you are holding receiving 1 share, how many shares you will be having at the end of the day? 4, right? So because bonus issue is considered for whole of the period, so that's why we are applying this weight as well for the bonus, right? And the amount comes or number of shares come 222. Then for next adjustment on 28th of February, we issued how many shares? 2 lakh, right? So 2 lakh shares we are issuing, right? So 2 lakh plus 10 lakh into 6 by 12 into my 4 by 3. So 8 would be the answer. And then for September, so on 31st of August, we are issuing the bonus, but we have already considered the impact of the bonus, right, in our calculation. All in total share I use, 2 lakhs issued. So how many? 12, right? 12 into 1 by 3. 3 fours are 12. So 4 lakh shares, right? So 4 lakh I have issued in bonus. 4 lakh shares I originally have. So how many shares I will be having now onwards? 16 lakhs into me for next 3 months, divide by 12, 4 lakhs. And then finally, I issued 2,50,000 shares after the bonus issue, right? Since they are considered after the bonus issue, so the why we are going to apply here, right? Because they are issued after the bonus issue, right? So how many? We will add 16 lakh plus 15,000, 18 lakh 50,000 into my 1 divided by 12, 154, 115 lakh 76, 389, right? So this is the one way of calculating this, but there is another way as well, right? So what in this case, which approach we had opted from these two approaches which we spoke about? What do you think? Which
I,
approach we have considered?
I think first approach.
First approach, right? So using the first approach, this would be the calculation. But even if we do use the second approach, right, the answer will remain same. However, the calculation will look different, right? So in this answer, the approach 1 is used, but you can calculate using the approach 2 as well, right? The answer will remain same. But whatever the approach you use consistently. Don't interchangeably use, right, in your practice. Otherwise, there will be, chances of error in your examination. Whatever approach you would like, with your comfort zone, just finalize one approach and then consistently apply that, irrespective of the fact the solution is solved in the textbook with which approach, right? You use your own approach always, right? Any doubts on this calculation?
Sir, I consider financial year from 1st Jan to 31st December. That's why
Hmm.
I got different answer.
Oh, okay. So I think, okay. So that was here, right? You understood the calculation, right?
Yes, sir. Your voice is somewhat breaking.
So I'm asking you, you understood the calculation, correct?
Yes, sir.
Okay. Any other thoughts or any other questions or query anybody wants to ask until now before I proceed?
In second method also, we have to multiply it by 4 by 3, multiply 4 by 3 for the first two.
So you are asking why we are applying these weights, right? 4 by 3.
Yes, can we apply this in the second solution?
So this is the approach 1. So that's why we have considered the bonus weight for calculation in this manner. But if we are using the second approach, so in that case, what eventually we will do? So we will do 10 lakh shares into my 12 by 12. So 10 lakh shares into my 12 by 12, right? Then 2 lakh shares, right? 2 lakh shares into my how much period it is, from January and February is off, right? So 10 months.
10
So
months.
into my 10 by 12, correct? Then
Correct.
third one is bonus issue. How many? 4 lakh shares, right? So uh, 12 lakh into my 1 divided by 3, 4 lakh, right? So 4 lakh shares is the bonus issue and into my 12 by 12, correct? And then lastly, 250,000 shares for how many period? December only, right? So 250,000. So 2.5 into my 1 by 12, right? So this would be the calculation using the first approach, right?
Right,
And
right.
answer will be same, correct?
Yes.
Answer is coming same. If you have the calculator, you can quickly check it.
Yes, it comes to around same 15 lakh 88,000. But there is a difference. Your answer is 15 lakh 76,000.
You what is the number answer with this approach? 15 lakh?
15 lakh 87,000, around
87.
500.
No, no, no.
50 lakh,
This much difference wouldn't be there. There could be some slight difference, but this much difference shouldn't be there.
okay, I will try again. Yes, again, sir.
So this approach is clear. So in this approach, what we are doing, we are simply going one by one transaction, right? But in this approach, what we are doing, we are factoring into the bonus transaction along with the main item, right? So that's the difference between the two approaches. And these are just calculation approaches. Doesn't matter which approach you follow.
Can you show the calculations for the first step?
Sorry, your voice is breaking. I did not hear clearly.
Can you show the answer for the first approach? I'm not getting the answer right.
You're not getting the answer. So are you multiplying 10 lakh into my 12 by 12? So 10 lakh, right?
Yes,
2
that's
lakh into my
that's
10 by 2 lakh into my 10 by 12, right?
10 by
So
12. Yes,
so
it
what
comes
is
to
the number?
167.
Sorry,
1 lakh 67, 1 lakh 66,667.
1 lakh 60.
1.67 lakhs. We
Okay,
can put 67 lakhs
right? And
approximately.
then 4 lakh into my 12 by 12. So again the 4 lakh, right?
4 lakhs. Yes,
And then 2.5 lakh into my 1 by 12. How much?
divided by 12. It comes to 20,833.
20,830.
833. Yes,
833. Okay. So what's the
yes.
total in that case? I did not complete these three digits. What were those?
Yes, it comes to 15,87,500.
15,87,500.
500.
No, no, no. This much difference is not possible. 10 lakh, 2 lakh, 4 lakh, and 2,50,000. And the periods are considered correct, right? So this is for the whole of the year, and bonus issue is also for whole of the year, right? And then these 2 lakh shares which we have considered is for 10 months, right? 6 plus 3 plus 1, right? So 10 months divided by 12, 4 lakh into 12 divided by 12, and 2.5 lakhs are the new shares, right? Which we have issued on 30th of November, means only for the month of December. So 1 month we have considered. So 2.5 lakh into May 1 by 12, right? Mhm. Over by 3. I think calculation wise, we have plotted the correct periods, and you have done the calculation right, right? These two. Anyway, this is easy, but these two are right, correct?
Yes. The second one is precisely 1,66,600.
This one, 166,667, right?
Yes.
166. This is what you are saying, correct?
Yes.
Okay. And the total of these is coming is 1587 only, right?
Yes.
Okay. Then can you quickly check this number? This number is coming accurate. These two numbers might be there is a typo error in that case. Are these numbers correct?
Yes, these are correct.
Both these numbers are correct.
All of them.
All of them. Okay. So let me check it at my end in the break, and I will come back after the break. Right. What's the issue?
Okay.
But uh, there might be a calculation mistake only we are doing as of now. But either of the two approaches, the answer will remain same, like we saw in our previous examination, previous question, right here. So whatever the approach you use, the answer will always be same, right? So I will figure it out what is happening over here. So, but before spending much time on this, we'll proceed. Now, deciding the date of the issue of the shares, right? So, because we are calculating the weighted average number of shares, right? And there could be multiple transactions taking place during the year, right? So, we need to understand from which date those issuance will be factored in for the purpose of this calculation. That is the weighted average number of shares. So, standard throws some guidance on this as well, that for the purpose of calculation of this weighted average number of shares, from which date you would be considering a particular transaction which has taken place right during the period. So standard says shares are usually included in the weighted average number of shares from the date consideration is receivable, which is generally the date of their issue. So standard says the general guideline from the date from which the consideration is receivable. What do you mean by the consideration is receivable? Suppose, let me take an example. If the company is going for an IPO, initial public offer, right, or a FPO, right, further public offer, then what would be the date? The date on which the money is received, or the date on which the shares are allotted, or the date on which the on which the prospectus is filed or the date on which the shareholder has applied or submitted the application form.
When the allotment.
So generally, we believe that the shares are allotted on that very date. Actually, should be the issuance date, right? But for the purpose of calculation of EPS, the standard is this is the purpose of the number. Allotment means to the demat account of the shareholders, right? That's what the allotment means. Is it clear? So allotment, what do you mean by the allotment of shares? So allotment of shares means the shares are allotted to the shareholder account of the right? Yes or no?
Yes.
Then standards be considered as date consideration is receivable. It means when the consideration is received or receivable. So it is already received, that of receipt. If it is not yet received, the date it will be receivable. So that it will be automatic because yes, hello, I'm audible. Okay, so there was some fluctuation in the internet. So, okay, let me repeat. So, what I was saying, the standard says that shares needs to be considered for the purpose of calculation of weighted average number of shares from the date the consideration is receivable. What do you mean by the consideration is receivable? So, consideration is receivable means when the consideration for those shares is either received, that is that date, or if the consideration is not yet received and shares are allotted first, then the date of allotment, because on the date of allotment it is certain that a consideration will be received, right? Now these are the situations the standard is giving the examples of which. Let's discuss one by one to crystallize what the standard mean to say. So when the shares are issued in exchange for cash, so whenever the company is offering shares for consideration in cash, right? So simple share issue to the shareholders. So it means when the cash is receivable, right? So it means if the cash is already received, then the date of the receipt, and if the cash is not yet received, then the date on which it will be receivable, right? Right? So when cash is receivable to the company, right? So that date which we needs to be considered for the purpose of applying weights. Then when issued on voluntarily reinvestment of dividends on ordinary or preference shares. So sometimes in some situations, what happens, company says instead of giving the dividends in the form of cash to the shareholders, we will reinvest those dividends and we will issue shares against those dividends to the shareholders. Possible, not possible?
Yes, possible.
Possible. So there are two scenarios. Number one, company declared a 10% dividend, right? And company is going to pay in cash, right? So that is a cash payment of the dividend and discharge of dividend obligation. But instead of paying in cash, company says whatever the number of shares will be equivalent to that amount of dividend will be issued to the shareholders. So in that case, what will happen? My share number of shares will increase or not by issuing those additional shares to the shareholders?
Yes,
Yes, correct. But they are issued in lieu of what? The dividends, which would otherwise be paid in the cash,
yes,
right? So
yes,
because that cash is no more being paid, and that cash instead of discharging to the shareholders is being reinvested into the business, and the shareholders are rewarded with the additional number of shares. So it means the date on which these dividends are reinvested. Now, what do you mean by the date on which the dividends are reinvested? Dividends are reinvested means the date on which those dividends are getting capitalized in the form of issuance of shares, right? So, dividends are not being paid in cash but are reinvested by issuing additional shares. Third, when issued as a result of conversion of a debt instrument to the ordinary shares. So it means when the interest ceases to accrue, right? So in this situation, what is going to happen? Suppose there is a uh, uh, investor who has invested into the bonds of the company or debentures of the company, right? And those bonds or debentures are convertible bonds or convertible debentures at some future date, right? And now the conversion is taking place. So by virtue of these getting converted into equity shares, now will the investor has the right to receive interest? No. So interest on those debentures or bonds ceased as and when these bonds or debentures are converted into equity shares. Is that correct?
yes,
So instead of calling it the date of conversion, standard uses the wordings the date on which the interest ceases to accrue in the books of the company. It means company is no more liable to pay the interest, and hence the interest accrual is stopped, right? Interest is recorded on accrual basis as an expense in our books of account. Yes or no?
yes,
Right? So standard uses the word interest accrual getting stopped. And on which date it will stop? On the date of the conversion. So instead of using the simple word, calling it as the date of conversion, standard is saying the date on which the interest ceases to accrue, right? Now what is the purpose of this? Why the standard is not using the simple version of the language, that is the date of conversion, rather using the wordings interest ceases to accrue? Why? What would be the state of mind of the standard writer who has written this standard? What was his thought? Any idea? Any guess? So the ideal scenario is we should have called it as the date of the conversion, right? the date on which the conversion is taking place, effectively resulting into the cessation of the interest accrual, correct? But it might be possible, in spite of the conversion, interest is getting continued, because there was a clause in the agreement that for next 1 year or next 6 months, interest will continue to be paid, might be. So until the interest accrual stops, the liability is not yet forgiven, right? And hence, in spite of the conversion, for the administrative convenience, it is not actually taking the shape of the number of shares, because interest is still continuing, and after say 3 months the interest will cease to accrue. So from that very date, these shares will be actually considered as the shares. Until then, they are piece of paper only, right? So just for administrative convenience between the company's management and the shareholder, right, or the investor in the bond, these bonds are converted and the new shares are offered to them, but these shares are not yet taking the shape of the real equity share until the interest clause gets abandoned or interest ceases to accrue. So just to avoid the dual impact on the company, that interest is continuing to hit the PNL while the shares are also increasing the base, right? So to avoid the dual effect, the standard setter has used the word interest ceases to accrue. Is that clear?
Clear.
Then another item, issued in place of interest or principal or other financial instrument, right? So again the same thing, when interest ceases to accrue. So for example, instead of convertible shares, there was a liability in the books of the company. For example, the company has purchased the property, plant, and equipment, okay, from one of the vendor. Now that vendor is sitting as a creditor in the books of the company for say 5 crore rupees. Now company negotiated with that vendor. So instead of we discharging your liability, right, in cash, can we offer the shares to you? And the vendor agreed, okay, no problem. Instead of paying 5 crore plus interest cash, you pay me, you pay me or discharge my obligation in number of equity shares, right? Then again, the same rule plays. Standard setter says the date on which interest ceases to accrue. Suppose if any interest was getting accrued on those overdue 5 crores to the vendor, then unless and until those interest clause is seized, until then we will not consider this as a issuance of shares for that very liability, right? So the same impact. So be it a originally convertible liability, or be it a liability which was not originally planned to be converted into the equity shares, but now being agreed to be converted into equity shares. So the rule book is the same, right? Unless and until interest ceases to accrue, we will not consider them as the shares are being offered. So that is done only for some administrative convenience, but actual the financial impact will come into play as and when the interest obligation gets avoided by the company, right? So that's why these wordings are used. Although in practical life, it rarely would be a different date, right? Because always companies uh, sign the agreement with the new clauses, and then only the shares are converted, right? Or the debentures are converted, or bonds are converted, or liabilities are converted. Then issued in exchange for the settlement of a liability. So if any other liability is simply getting settled, right, which is not bearing any interest, then which date we need to consider? The date on which the settlement has taken place, right? When both the parties, the company as well as the vendor, have agreed upon to sign to receive the number of shares against the liability to be paid off in cash otherwise. So, right? So the date on which this settlement is taking place, that date will be considered for the purpose of calculation of weighted average number of shares, right? Then issued as a consideration for the acquisition of an asset other than cash, right? So same example which I just took, instead of negotiating with the vendor after the purchase, I am negotiating with the vendor at the time of purchase that you provide me the raw material or the plant and machinery, and I will give you the number of shares instead of the cash. So this is the contract. So I'm purchasing the property, plant and equipment, and instead of agreeing upon to pay in cash, I am agreeing at the inception of the contract itself to discharge this obligation in the number of shares, right? When we talk about this, are you able to recall some other standard where similar discussion you might have had?
India's 16?
India's?
16.
No, 16th property, plant and equipment. 102. Share-based payments.
Okay, yes.
Yes. So under India's 102 also, you must have, observed these type of situations where, companies purchasing anything from the third party, right? In lieu of discharging that liability by issuing the number of equity shares, right? Share-based payments, the standard, if it is already done in this batch.
Yes, done.
Yeah.
Already done.
Yeah.
Yes.
Right. So that standard only tells you how to do the accounting, right? But this standard is not telling you how to do the accounting. This standard is saying how you will be considering those shares which are issued by the company in lieu of purchase of any goods or services, right? For the purpose of calculation of earning per share. So that's the difference. So we are not getting confused. So India's 33 is nowhere, you know, uh, impacting whatever we have learned under India's 102, right? So India's 102 talks about accounting presentation and disclosure, but India's 33 only talks about how the weighted average number of shares will be calculated for the EPS and DEPS calculation, right? So there is no clash, right? So what the standard says? The standard says when the acquired asset is recognized. So if I have received the property, plant and equipment, the date on which the property, plant and equipment is capitalized, or if I am receiving the raw material, goods or services, then the date on which I am receiving those services, right? Or I am receiving those goods or raw material from that supplier, right? So on that very date, from that very date, I will be considering how many number of shares I have issued to that vendor for the purpose of calculation of my denominator. Is that clear?
Clear.
Then another one, issued for rendering of services to the entity. For example, I have taken the services of a marketing agency for the promotion of my products, or from the lawyers for any legal disputes they are handling for the company, right? So from which date the number of shares will be considered if I have issued some shares to my lawyers, to my marketing vendor, or to my advertisement agent, right? So the date on which those services are rendered. What do you mean by the date of the services rendered? So when the lawyer has appeared in court for providing me the service, that date, right? Or when the advertisement was published into the media. For example, if it is a newspaper advertisement, the date on which the advertisement was published in the newspaper, or if it is on the radio, the date on which the advertisement was telecasted on the radio, or if it is a telemedia, television media, then the date on which it was telecasted on the television, right? So that's how I will calculate the periodicity from which the number of shares will be taken care for the purpose of calculation of weighted average number of shares, right? Then issued as
I have
part
a,
of.
I have a question on this lawyer appears in the court. He may be appearing over
So, okay. So
many
generally,
period.
how we will come to know the date of the lawyers when they have rendered the service? Generally, when they invoiced us,
Okay, but
right?
they appear over a number of days, not necessarily every single.
So, of course, I'm not going to calculate for each day. So, whatever I will be taking, the date of the invoice. So, suppose they have appeared, say, 5 times in last 1 month, and they have invoiced me on a monthly basis. Then that monthly invoice date, I will be considered for administrative convenience in practical life,
Okay.
right? So, the concept is a standard wants to us to doubly sure that the services are actually received by the company, and the shares are, even if the shares are issued before the receipt of the service, then those shares will not be considered as issued. That's what the standard meant to, right? So even if company issues the shares in advance in expectation of the services or goods received to be in future, then those shares will not be considered for this calculation, right? So standard says the shares will be considered for the purpose of this calculation only when the goods and the services are received by the company, right? So that's why the standard is using the word services are rendered, goods are received, right? So services are rendered means when the services are rendered by the other party to the company, and how the other party will be rendering the services. For example, if it is a marketing agency, they have published or telecasted our advertisement, that means the service is rendered. If it is a lawyer is fulfilling its obligation by appearing in the court or by drafting the papers whichever we have asked for, right? So once the drafted papers are received by the company, the service is deemed to be delivered or rendered by that party, right? So we strictly don't go by the date on which the lawyer is actually going to the court, but we will see whether the service of the lawyer is delivered to the company or not. If it is not yet delivered and the invoice is received in advance, then we will not consider, right? So service has to be delivered. Correct?
Right. Yes.
Then issued as part of the consideration transferred in a business combination. Ind AS 103 already done in this batch?
No, not yet done.
Not yet done. So what Ind AS 103 says? So Ind AS 103 says business combination. So there are two companies. One is the acquirer who is acquiring the another company, which is called acquiree, right? So acquirer is acquiring the another company, the acquiree, right? That is called business combination. Now, there is a date on which this acquisition takes place. That date is regarded as the acquisition date in that standard, right? On that acquisition date, it is assumed that whatever was being intended to be acquired is acquired successfully by the acquirer, right? So acquisition date translated into the transaction that all the assets and liabilities of the company which were intended to be acquired by the acquirer are acquired effectively. So that acquisition date, either it is decided by the shareholders or board of directors or the court, as the case may be, right? So if it is a court decision driven acquisition or merger, then the acquisition date corresponds to the order of the court. If it is not court driven and if it is the shareholders driven decision, then the approval date from the shareholders will be considered. Or if it is not even the shareholders or some other incidents, then that date. So acquisition date is defined within that standard in detail. So whenever you go and read that standard, you will be clear what acquisition date means under different scenarios, right? But for my purpose here, limited discussion, on the date of acquisition only, we will consider the number of shares being issued. So even if the shares are issued before the date of acquisition or thereafter, that is a administrative adjustment. But for the purpose of calculation of the weighted average number of shares, which date I will consider? The date of acquisition as defined by Ind AS 103, right? Or as decided under Ind AS 103. So date of acquisition will be considered for giving or applying the weight on the number of shares. Which number of shares I am talking about here? The number of shares which the acquirer company is issuing to the shareholders of the acquiring company in lieu of the acquisition, right? Purchase consideration getting discharged by issuing equity shares, right? Are you able to correlate now?
Yes.
Right? So date of acquisition will be considered as the date on which these shares will be calculated for the purpose of weighted average number of shares, right? So standard clearly says deciding the date for the issue of shares. So it is not saying that on this date the company needs to issue the shares. No. Company can issue the shares on any date as per their choice. But for the purpose of Ind AS 33, these are the dates from which we will take into consideration for the purpose of calculation, right? So that's the limited purpose of the standard. Issued upon the conversion of a mandatorily convertible instrument, bond, debenture, or preference shares, right? So from the date of entering into the contract, which contract? The conversion arrangement. So the date on which this contract has been entered into, that these shares are getting converted, right? So from the all this discussion, are we saying this is the exhaustive list of uh, scenarios, or this is an illustrative list?
Yeah, I think exhaustive list. Illustrative.
This is
Okay.
illustrative, right? It doesn't cover all the scenarios, right? So this is an illustrative list which the standard has given to us for our easy understanding, and we need to apply similar logics to any other transaction or scenario which is not listed here, right? Okay. Another item which we will talk about is contingently issuable shares. What do you mean by contingently issuable shares? Any idea? So let me take an example. You will tell me whether it is contingently issuable or not, right? Suppose A Limited has agreed with B Limited to issue shares after 3 years. So this is the agreement between A Limited and B Limited, that A Limited will issue some shares, say 100 shares, to B Limited after 3 years. So these shares are not yet issued, correct? They are not in issue today, correct?
Yes, correct.
But they will be issued after the 3 years lapse of time. Now, what do you think? Are these shares to be considered for the purpose of calculation weighted average number of shares?
Yeah, I think yes.
Yes. Okay. So you mean that if a company agrees to issue the shares to any shareholders in future, all those shares will be forming part of my share capital today. Yes, no?
No, not forming part of the shares today
Hmm.
because they are yet to be issued.
They are
They will
yet
be
to be
issued
issued.
after 2 to 3 years. Yes.
Right. So they are to be issued after 3 years. Then should I include them today for the purpose of calculation of number of shares?
I think not.
No, right? So I am not going to include these future issuance of shares, because if I am going to include all the future issuances as well, then it will be cumbersome for me to calculate the EPS, right? So EPS, for the purpose of calculation of EPS, whatever the shares are to be issued or are issued already, right, needs to be considered, right, for the basic earning per share. Then, are these shares dependent on certain contingency, that whether they will be issued in future or not?
Yes.
Is there any contingency involved?
So if it is not a binding agreement, then there is a contingency.
What is that contingency? What is that contingency?
That the company may not issue the shares.
Okay, so you are saying if there is no binding agreement between the two parties, the contingency is that company may skip issuing the shares. But there is no contingency. That is the change in decision by the company, right? the decision they have taken, they are not, going by that. But there is no contingency, right? Then
Sir,
what
there
the
may be events when that happens, then only we can convert it to shares or issue shares.
correct. You are closer. So contingency means that shares will be issued or not depends on a particular event which will occur in future, which is not in control of the company, right? So that is the contingency, right? And if that event occurs, the company will issue the shares. If that event doesn't occur, the company will not issue the shares. So that is the contingency. So contingency means any event which will occur or not occur in future, and the occurrence or non-occurrence of that event will decide whether the shares will be issued or not. Is that clear?
Clear.
Right? So let's do the example first. We will come back to the literature. AB acquires a company in 2001 for the consideration to be discharged in shares. So PC, purchase consideration, is to be discharged in shares. If the profit for the calendar year 2001 and 2002 meet the targets of ABC Limited, then ABC Limited will issue some additional purchase consideration or some additional shares to the vendor, that is the acquiring company, in February 2003. These additional shares will be included in the weighted average number of calculation from 1st of January 2001 or from 1st of January 2003.
When the conditions are satisfied, that would
When the
be
conditions are satisfied,
2003. Yes.
right? And conditions are getting satisfied only when the year 2001 and year 2002 are getting closed, right? Then only I will come to know whether the profitability or sales targets are met or not, correct?
Yes.
Then in that case, until then, I cannot consider these shares in my calculation of weighted average number of shares because I don't know whether these shares will actually be issued or not, right? So until the contingency is what? The target profits, target sales or profits for 2001 and 2002, right, are available. So when these are available, only when the 2002 year gets completed, right? So after the completion of the year, is it certain that the targets will be met? No, because targets will be met or not, it is not clear, right? So it will be clear only after the completion of the year 2002, and we can land up into two situations: targets met, targets not met.
Yes.
Right? Yes or no?
Yes.
So if the targets not met, then the shares, additional shares will be issued or not?
Yes. If targets are met, then will be issued.
So for targets met, additional shares will be issued. For targets not met, additional shares will not be issued. Right?
Right.
Right? So what is the contingency? The contingency is to pass by the year 2001, 2002, or the contingency is targets are met.
Targets are met.
Targets are met. So simply the passage of time, that is the completion of the year 2001 and the completion of year 2002, is a contingency or not a contingency?
Time period is not the contingency.
Time period is not contingent because even if you do nothing, time will fly, right? And that is equally applicable on our studies preparation. So if we don't do the preparation or the studies, time will anyway pass, right? Time will fly. So time is not contingent on anything. Time is tick by tick passing, right? So there is no contingency related to the time. The only contingency is related to the event. What event is that? Profitability or the sales number, which we have agreed upon. So if the particular profitability or the sales are met, the acquirer company will issue additional shares. If they are not met, the acquirer company will not issue additional shares, right? Now, what do you mean by contingently issuable shares then? So now we will read the definition. Contingently issuable shares are treated as outstanding and are included in the calculation of the basic earning per share only from the date when all the necessary conditions are satisfied. That is, the events have occurred, right? Which event? The contingent event. Time is a contingent event? No, time is not a contingent event because time is a certain event. Time will always pass, whether you do or whether you don't do anything, right? Shares that are issuable solely after the passage of time are not contingently issuable shares because the passage of time is a certainty, right? Time will anyway pass, right? So passage of time is a certainty, hence time is not a contingency. The only contingency is the condition basis on which the shares will be issued or not. And that condition in our example is the profitability, target profitability, right? Outstanding ordinary shares that are contingently returnable. So I will come to this after some time. Now, is the concept of contingently issuable shares is clear?
Clear.
Clear? So what is the conclusion? Contingently issuable shares are those shares which the issuance of whom is dependent on occurrence or non-occurrence of certain future event other than time, because time is certain to pass. Correct?
Yes, correct.
Right. So now we have discussed contingently issuable shares. Instead of issuable, if I say contingently returnable. So issuable means company is issuing the shares to the investor, and returnable means the company is taking back the shares from the investor. Possible, not possible?
Yes, possible.
Possible. So standard says outstanding shares that are contingently returnable. So they are also returnable to the company on certain condition or on certain event which will occur or not occur in the future, subject to recall, are not treated as outstanding and are excluded from the calculation of the basic earning per share until the date shares are no longer subject to recall. So what does that mean? That if there are any shares which the company will get back from the shareholders, right? And they are dependent on a certain contingency, for example, subject to recall. That is, if the company calls, make a call or send the emails to the investors that, okay, boss, return your shares, right? And that is the only contingency, that this is subject to recall only. That is subject to demand by the company. Then they are not treated as contingently returnable. Rather, they are treated as returnable, right? Because there is no contingency. The only contingency is that company is making this call, right? So even if the company makes this call or doesn't make this call, these shares are always treated as returnable shares. And because these are returnable, they will be excluded from the calculation of the basic earning per share. So let's understand this with an example. I'm finding some white space. So let me use this space only. So suppose ABC Limited right has a share capital of 10,000 shares of rupees 10 each. So 1 lakh, right? This is the share capital. Now ABC Limited has acquired XYZ Limited, right? And they have issued 2,000 shares as a purchase consideration, and plus they will issue 1,000 shares to XYZ Limited after 3 years. right, of time period. That is, the company ABC Limited successfully integrates the business of XYZ Limited with the business of ABC Limited. So they will issue 2000 shares upfront and 1000 shares after 3 years, right? Tell me how many shares you will consider for the purpose of calculation of denominator for calculating basic earning per share. So 10,000 anyway plus 2000, right? Ignoring the dates for the sake of simplicity, plus 2000. Now, what about 1000? 1000 you will add or not?
So, will there be any additional conditions to be satisfied for these 1000 shares?
No, there are
If
no
not,
additional
then
conditions.
if then these will be added because they have already acquired and contracted that we will issue another 1000 shares. So these will be added.
So this will be added. So your answer is 13,000, right?
Yes.
Okay. Any other answer? Any other answer anybody has? Everybody is unanimously agreeing that the answer would be 13,000 in this case. Okay. So Neha is also saying 13,000. Okay. Right. So because there is no contingency, so these shares are not contingently issuable shares. Rather, these shares are issuable shares only. Right. So there is no contingency. Right. Now, it's just a matter of fact that three out of the 3,000, only 2,000 are being issued now and 1,000 later. Right. Now, these 1,000 shares are to be issued only if 3 years total profits pass or is above 100 crore. In that case, when I will come to know about this condition? Only after the completion of 3 years,
Yes.
right? So after the completion of 3 years, if the outcome is say 95 crore and the outcome is 105 crore. So in case of 95 crore, whether I will issue these 1,000 shares?
No.
No. So in that case, these are not issued. And if the outcome is 105, then I will issue these 1,000 shares.
Yes.
So in that case, I will issue. So in case the outcome is 95 crores, then answer would be 12,000, 10 plus 2,
Yes.
right? And if the answer is 105, then again the answer will be 13,000,
13,000.
right? So unless and until the outcome is there and the conditions are satisfied, right? I will not consider these shares to be issued, right? For the purpose of my weighted average number of shares calculation. So that's what the standard says. Shares that are issuable solely after the passage of time are not contingently issuable shares because the passage of time is a certainty. But if they are contingent on certain condition, then from which date I will consider? Only from the date when the conditions are satisfied. That is from the date of 1st of January in this example, or from the third year in my this example, right? After the completion of 3 years, right? Clear concept?
Yes. So what is that until the date the shares are no longer subject to recall? I could not understand.
Okay, returnable you are asking, right?
Returnable. Yes.
Okay, I'm repeating. Outstanding ordinary shares which are already issued at present and are returnable to the company by the shareholders subject to recall by the company. Unless and until company makes a call to return, shareholder cannot put the shares back to the company. So it is the decision is in the hands of the company whether they want to recall these shares or not. Is that clear?
That much is clear. Yes.
Right. Now, subject to recall means subject to the call action by the company are not treated as outstanding and are excluded from the calculation of the basic earning per share until the date the shares are no longer subject to recall. So it means if the company has a 10,000 shares, suppose let me use the white space here, 10,000 shares, right? Out of these 10,000, 2,000 shares are subject to recall returnable, to the company by investors. So investors cannot put back these 2,000 shares to the company at their wish, but they need to wait for the company's call. And if the company doesn't make this call, these shares are not returnable. But if the company makes the call, these shares are returnable. So because it is in the hands of the company to make a call or not, so that's why these shares are considered as returnable anyway and not contingently returnable, right? And they are not treated as outstanding and are excluded from the calculation of basic earning per share because these are recallable shares. So callable shares will be excluded because company can call them at any point in time. Clear?
So the date the shares are no longer subject to recall means now the company will not recall in future.
So company will not consider, no, so they are anyway outstanding because company has not yet made a call, right? So from the financial statement perspective, they are outstanding. But for the purpose of calculation of weighted average number of shares, they are treated as not treated as outstanding.
Right.
Right. So for the purpose of this denominator calculation only, we will say because these are callable shares, we will not consider them as outstanding, right? Because company can call them anytime, right? But if the shares are not yet called, in my financial statements, they will continue to be part of my share capital unless and until called back. Clear?
Yes, clear.
Okay. Another important concept is right issue, but I think it is a break time for you. So let's have a 10 minutes break quickly, and then we will come fresh to understand the right issue concept because right issue concept is, the crucial topic. And if the question in the examination comes, 95% probability is it will come on the right issue. This is high importance topic. So let's start after the break of 10 minutes. We will come back at 9:45. Oh, sorry, 8:45. Fine. Yes. So the new item which we are going to talk about is the rights issue. What does right issue means, and how they are considered for the purpose of calculation of weighted average number of shares, right? So that's what we are going to discuss now. So what do you mean by the rights issue? So there is a initial public offer, IPO. There is further public offer, FPO. There is a bonus issue, right? There could be a private placement, and there is a rights issue, right? So IPO means when company initially offers the shares to its shareholders, right? Then FPO means when company comes with a further public offer, and public means the entire public, right? Anybody can exercise. Then bonus issue is done to the existing shareholders, right? Existing shareholders, right? And then private placement is done to selective shareholders, right? Selective existing shareholders, right? And then the rights issue. What do you mean by the rights issue? So right issue is the issue whereby company offers certain shares, right? Certain shares at reduced price, right? To all of its existing shareholders, right? Existing shareholders. So whoever is the shareholder of the company will be entitled rights issue. So any person who is not the existing shareholder of the company will not be able to participate in the rights issue, right? Is that clear? So right issue is the issue only for its existing shareholders, right? And why the existing shareholders will be convinced to purchase more shares of the company? So to make the offer lucrative, suppose the company share price in the market, if it is a listed company, or even if it is not a listed company, the fair value of the share is say rupees 188 per share, and company offers the rights at say 160 rupees. Then because in the market the share price is 188, and because company is offering at 160 to each shareholder, so as a shareholder or as a prudent person, everybody will be motivated to purchase more shares, because they can purchase the shares at 160 and sell them off in the market at 188. Possible, not possible?
Possible.
Possible. So generally what investors does is, so whenever the company announces the rights issue, then they sell the equivalent number of shares in the market and apply in the, because in the market the price is high, so they sell the shares in the market, and the number of shares they sell, they can get them back from the company under the rights issue, right? So their shareholding will remain same. For example, the 1,000 shares anybody was holding, and suppose they are entitled on those 1,000 shares 100 shares in the rights, so they sell it off 100 beforehand, realize them at a 188, and then apply the right issue at 160 for 100 shares, and they will eventually be receiving 100 shares at 160. So they have played the arbitrage, and they have gained by this right issue subscribing, right? Getting my thought, what I'm talking about?
Right.
Right. Now, in case the investor doesn't subscribe for the rights issue, right? Then what do you think the investor otherwise could do? So they can renounce that right to some other person. Possible, not possible?
Possible.
Possible, sir.
So possible. So earlier, what used to happen, these renouncements of rights were done manually, but because today the technology is playing a vital role in all our transactions, so these rights entitlements also get listed on the stock exchanges, and you can trade buy or sell these rights entitlement to on the stock exchange. So the person who is getting these rights issue by virtue of being the shareholder will eventually be able to sell those rights entitlements over the exchange to any other person who is interested in buying them, right? So these are also tradable now on the exchanges, but that is not my topic of the day. So my topic of the day is how these number of shares which eventually the company will be issuing under the rights will be considered for the purpose of calculation of my denominator, that is the weighted average number of shares. So standard says right issue has features in common with a bonus issue and the issue at a fair value. So because right issue is happening at some discount, for example, in my previous example, the fair 88, but the shares are offered at 160, right? So how much discount is being offered? 28 rupees, correct? So 28 rupees per share is the discount offered, right? So 188 rupees is the price of one share, right? And 28 rupees is the discount on each share under the right issue. So can I say that I can calculate the full number of shares and the free shares as well in the issue? Because if I accumulate 28 rupees until I reach 188, right? Or maybe I can simplify the calculation. Suppose this is 200 and this is 160 and this is 40, right? So 200 divided by 40, right? So 5, right? So if I offer, say, X number of shares at 160, then can I say for 5 shares out of those X number, right, would be a bonus issue? Because I am
Yes.
getting no consideration, and for X minus 5 into 200, the full price I am charging, and 5 into my no price, and X minus 5 into my full price will be equivalent to X into my 160. So we can solve this equation, right? So right issue consists of two components. One is the shares issued at the full price, that is the fair price, and some shares for no consideration, that is for zero consideration, like the bonus. So let's understand this with this example. At 31st December 2001, the issued share capital of the company consisted of 1.8 million ordinary shares of rupees 10 each fully paid. The profits for the year ended 31st December 2001 and 2002 amounted to rupees 6,30,000 and 8,75,000 respectively. On 31st of March 2002, the company made a right issue on a 1 for 4 basis at rupees 30, right? So right issue price is how much? 30, and the market price is how much? 60 before the right for this issue. So one share fair value is 60 and one share right issue is 30, right? So it means I am giving some shares for free and some shares for full fair value 60. That's why the discounted price 30 is there. And what is the right? One share for every 4 share held. One share for every 4 shares held, right? So this is the question. Calculate EPS. So very simple and straightforward question, right? So let's understand how the calculations are being done here. Solution. Initial holding, suppose, is then 4 shares. Then rights is how much? 1 share. Then after the right, the new holding, the shareholder will have how much? 5 shares. 4 shares market value is 4 into 60. That is the market price, existing market price, 240. Then the new share cost is 1 into 30. So 30. And total cost or total price for the 5 shares after the right would be 270, the summation of the two, right? So theoretical X right price would be 270, the total price or total value of the shares, divided by the total shares, that is 54, right? So 54 is the X rights price. Until now, it is clear,
Clear.
right? So easy to understand and simple to calculate, right? No confusions. Now we will calculate the bonus element. How the bonus element will be computed? The bonus element of the right issue is given by the fraction market price before the right issue divided by the theoretical X right price. So market price before the right issue is already given in the question, and theoretical X right price we have just computed above, right? So this 60 by 54 is equal to 10 by 9, right? So this is the bonus element, right? So this corresponds to the bonus issue of 1 share for every 9 held, correct? Because post bonus, the 10 shares are there for every 9 held. So bonus is 1 share for every 9 held, right? So 9 by 9 plus 1 by 9 is equal to 10 by 9. Is that clear? Yes, no?
Can you repeat this part? 9 by 9, 1 by 9.
So what I'm saying, this calculation is clear. 240, 30 and 270, and
Yes,
270
clear.
divided by 5, 54, right?
Right. This is
Right.
clear.
This is clear. Now we are calculating the bonus element. Bonus element is a fraction within this, total offer of the right? How that is computed? The formula is market price before the right issue to be divided by the theoretical X right price calculated above. So market price is how much? 60 rupees, which is already given in the question, divide by theoretical X right price 54, right? So this is the 10 by 9, right? So for each 9 shares, 1 is the bonus and 9 is fully paid. So 9 is the fully paid, and 1 is the zero paid. So total 10 shares for 9. So this is the total ratio in which 1 share is the free of cost and 9 shares are fully paid, right? So let's understand this with this calculation. So original holding was how much? 1800 in thousands. 18 million is the 1.8 million is the number of shares, right?
Yes.
So 1800 in thousands, and right issue is 1 share for every 4. So 1800 divided by 4, how much?
4,50,000.
4,50,000. So in thousands it would be 450.
Yes.
Holdings after the right issue, summation of the two, 2250.
Yes.
Now original 1800,000 shares valued at rupees 60, the pre-right fair value in the market 60. What is the value? 108 million.
Right.
Then 450 shares are issued under the rights issue at a rights price 30, which is given in the question per share. How much value is procured from the shareholders? 13.5.
Yes.
Then the summation of these two is how much? 121.5,
Yes.
right? So total number of shares after the right is 2250. and the total fair value of the shares after the right is 1 to 1.50. Can I present the same information with the division of number of shares and value, corresponding value into the rights and the bonus component? So let's start again. Original holding is how much? 1800.
Yes.
And bonus component is how much? 1 for 9. So 1800 divided by 9 into my 1. How much?
200.
200. So total number of shares 2000,
Yes.
right? And then how many shares were actually offered in the right? 450
Yes.
minus how many are considered in bonus? 200.
200.
So the balance would be
250.
250. The same total I can present 2250. So basically I am just splitting the total right issue into two parts, the bonus shares and the shares issued at full value,
Yes.
right? Then 1800 at rupees 60. How much is the value? 108.
Yes.
200 bonus issue
Nil.
at nil value. How much
Yes.
is the value? 0,
Yes.
right? Then 2000 shares at rupees 54 per share, 108. Then 250 shares issued at
50.
154 per
30.
share, 13.5, and 121.5 would be the total again.
Valued at 50. It should be at 30 rupees. No?
Which one? Sorry.
The rights issue.
Right issue is being offered at 30, but the total number of shares is offered at 30, not the 250, 450 shares at 30. But now we are dividing this 450 into two components, 200 and 250 issued at full value.
Okay. Okay.
Now, what is the objective of this doing? To understand what is the meaning of right issue. So right issue leads to a situation where the shareholder is indifferent as to whether the entity makes a right issue of 1 for 4 at 30 or a combination of bonus issue 1 for 9 followed by 1 for 8 at full market price, right? So there is a combination of contracts. So whenever the company comes up with the right issue, it is actually coming up with the two items. One item, the bonus issue, certain number of shares are being offered for free, and so remaining number of shares are offered at full value, right? So that's what right issue means, right? Having calculated the bonus ratio, the ratio should be applied to adjust the number of shares in issue before the rights, both the current year as well as the previous year. Therefore, the weighted average number of shares in issue for the current and the previous period adjusted for the bonus element would be weighted average number of shares. Now we have 2 years in question, right? And original shares for both the years were how much? 18 million, correct? 18 million is the total number of shares the company initially had. Then bonus for 9 is 2 lakh shares, right? So the shares after giving effect of the bonus issue for whole of the period would be 20 million for both the years. So forget about the right issue for the time being. We have learned that bonus issue needs to be given effect from the day one. Yes or no?
Yes.
Right? So forget about right. So within this right, there was a bonus element. What was that? 1 for 9, right?
Yes.
So 1800 divided by 9, 200, right? In our this question, 200, right? Here it is. Sorry. Correct? So 2 lakh shares on 18 million shares would be the bonus element. So bonus elements needs to be adjusted from which day? The day one, whole of the period. and for the comparative year as well, it needs to be adjusted from day one,
Yes.
right? So can I calculate the revised number of shares for both the years, which eventually would be 2 million, that is 20 lakhs,
Yes.
right? Now, the number of shares, 2 million for the comparative year, and now for the current year, we also have the rights. So 1.8 million into my 10 by 9 into my 3 by 12. Why 3 by 12? Because the date of the right issue given in the question is which one? 31st March,
31st March 2002.
right? And my
Yes.
year end is December, correct? Correct?
Yes.
So 3 months weight needs to be applied. So 3 by 12, and then the total number of shares 1.8 million plus right into my 9 by 12 after the right issue, right? So 5 lakh and this. So total number of shares would be this and this for the previous year. So if we don't calculate the bonus element within the rights issue, then what mistake we will certainly make in the calculation of EPS? Two mistakes. Number one, we will not be able to adjust the bonus component for whole of the period for the current year. Number two, we will forget to adjust the bonus component for whole of the period for the comparative period or comparative year, right? So by calculating the bonus component first and adjusting it, we are ensuring that it is considered for whole of the period, right? For whole of the period for both the years, right?
Yes.
Now, once we have calculated these number of shares, then what are the profit figures? 875 and 630 given in the question. Then weighted average number of shares is this much and this much. So 40 paisa is the EPS and 35 paisa would be the EPS. And reinstated number would be 630 divided by 20 million, 31.5 paisa. So for the previous year, two basic earning per share we have calculated, right? One without reinstatement of the bonus component and the other after the reinstatement of the bonus component, right? So that examiner in the question knows that we understand the concept of adjusting the bonus for the day from the day one for both the periods, the current period as well as the comparative period, right? So this is how the calculations are being done. Any questions?
So in 2002, weighted average number of shares would be 21,87,500.
Correct.
Look, I can't understand this. 1.8
Okay.
million into 10 by 9.
Mhm. Okay. So 1.8 million is what? The base number of shares?
Yes, sir.
Base number of shares, right?
Yes.
And for how
Yes.
much period they were outstanding? 3 months. Because on 31st March, the right issue is happening. So from 1st of January, XX to 31st of March, XX is how many months?
3 months.
3 months, right? So 3 months and the whole year has 12 months.
Yeah.
So 3 by 12 is the weight. So this weight is understood.
Yes.
And this 1.8 million base number is also understood, correct?
Yes. Yes, sir.
Now, this ratio 10 by 9 is the same ratio which we have just calculated here. Here it is, right? What is this? This is the bonus element of the rights issue, right? 60 by 60, that is the market price before the right issue, divided by the theoretical X right price. So 10 by 9. So we have just factored it 10 by 9. So this gives us the number of 5 lakh shares, right? and then 2.25. How this number is arrived? 2.25. Here it is. 2.25. Right? After considering the right issue. What is the number for the remaining 9 months? So for the remaining 9 months, divide by 12. The total number of shares are post right issue. So 18 million plus 4.5. What was that number? 4.450, right? 450. So this is 2250, right? So 225 million basically, right? Into my 9 months, remaining 9 months, April to December, right? After the right issue. So this is fetching me 1687,500, and the total number of outstanding shares for the current year is 2187,500. For the previous year, without bonus reinstatement, it was 18 million, and with bonus reinstatement, it is 20 million, right? We have already calculated that here, 18 and 20, right? So for the previous year, the original EPS was how much? 35 paisa. But as we reinstate the number of shares, then my reinstated basic earning per share for the previous period stands at 31.5 paisa. Is it clear now?
Yes, sir. Clear.
Right? So you just need to practice, few practical questions at your home on the rights issue, right? For different, uh, you know, uh, right ratios, and you will master the concept. Now, the standard says how the right issue, the calculation of number shares is done. So this is the formula given by the standard, which we have already applied in this numerical. Now, once we are done with the numerical, let's understand what's the formula. So standard says number of shares for all the periods before the right into number is equal to number of ordinary shares outstanding before the right into fair value or market price per share immediately before the right, divide by theoretical X right price, right? And theoretical X right price is the fair value of the original shares plus amounts received by the right issue. So fair value of the original shares, we have calculated here 18 million. 18 million into my 60, 108 million, and 450 shares into my 30, 13.5 million. So total is 121.5 million, right? Divide by 2250. That gives us 54 rupees, right? So this is how it is defined. Fair value of existing shares plus value received from the right issue by the company. So total of these two values divide by the original number of shares plus shares issued in the right issue, right? So total value divide by total shares, it will give you the theoretical X right price. Now theoretical X right price once computed will form the denominator and fair value or market value per share immediately before the exercise, right? So what was that in our example? 60. And what is this? Divide by 54, right? Into May. Number of ordinary shares outstanding before the right issue, 18 million, right? So 18 million into May, 10 divided by 9. 9, 2 is 18, 2 into May 10, 20, right? So 2 million. So 2 million are my bonus component within the right issue. So this is how we have calculated. Is that clear?
Clear.
So just practice few more questions on the right issue and you will be able to solve these calculations. Okay, the another important item. So is the diluted earning per share. So until now, we have been, talking about the basic earning per share, right? So basic earning per share means the earning per share the company has basis on what the earnings are attributable to equity shareholders divided by the as existing number of equity shares, right, which the company has already issued, right? But there could be a scenario where where there is a possibility of certain shares getting issued for some other instrument which have not yet taken place, right? And if those instruments are converted, for example, convertible preference shares, convertible debentures, options, shares, warrants, etc., are exercised, then they will result into additional number of shares being issued by the company. So in case they come up with the additional number of shares will be issued. So if we consider those probable issuance of shares as well in our calculation of weighted average number of shares and the corresponding impact of those instruments on the numerator in the form of leaving or cessation of the interest or cessation of the dividends, right? So earnings denominator and weighted average number of shares, uh, earnings numerator and weighted average number of shares denominator, both the items will be updated with these instruments adjustments, right? And then whatever the ratio comes, that will be regarded as the diluted earning per share, right? So diluted earning per share is adjusted for after tax effects of any dividends, interest, and income or expense items related to the dilutive potential ordinary shares. And potential ordinary shares, the definition we have already studied. For example, options, right? Share warrants, or any other instruments which result into issuance of equity shares or ordinary shares, right? So these are not yet shares, but these are potential shares, right, which will be there in future provided these instruments, option, share warrants, or convertible debentures, convertible bonds, are replaced with the shares, right? So that's why these are called potential. And because they have the potential to be converted into the equity shares, so if we consider them as a shares only today, then we will update our denominator, that is the existing number of shares plus pause potential ordinary shares. So this will give me total number of shares which will be there on my balance sheet in future provided these pause are issued. And because once these pause are issued, so it means the obligations in the form of dividends or interest payments on these instruments will no more be there. That will all be gone away, right? So because numerator, I am calculating the earnings available for equity shareholders, these earnings will also be updated with those adjustment, the interest or the dividends component on these pause, which will be no more there, right? So let's do a question first and then we will come back to the concept. Entity A has in issue 25,000 4% debentures at a nominal value of rupees 1. The debentures are convertible to the ordinary shares at a rate of 1 to 1 at any time until 2009. The entity's management receives a bonus based on 1% of the profit before tax. A's results for 2002 showed a profit before tax of 8,000 and a profit after tax of 64,000. For simplicity, tax rate is 20%. As question, calculate the earnings for the purpose of diluted EPS. So you need to calculate the numerator. So would you like to try this quickly? So Manish has answered 63,200. Okay. Others? Any other answer? Okay. So let's see how the earnings will be computed. So profit after tax as given in the question is how much? 64,000. This would be the starting item. Then add reduction in the interest cost, because once the bonds or debentures are converted, interest will no more be payable on them, right? So how much interest we are paying on them as of now? What is the amount of interest? 25,000 into my 4% debentures, right? So 25,000 into my 4%. Amount 1,000. Then the tax expense, because it will be a saving for the equity shareholders, right? So tax expense would be deducted. But now, since interest cost will no more be there, right? So interest cost expense will actually be saved, and the tax which used to be saved on that expense, right, is now no more a saving. Are you getting me what I'm saying?
Yes, this is understood.
This is understood, right?
Yes.
Because when interest was being expensed and charged off in the P&L, right? So at that time, by way of claiming this expense, we were able to save tax, right? But now, because interest will no more be there in my P&L, so the tax which was being saved on that will not be saved, right? And because that will not be saved, so that will be deducted. So either I could adjust it here itself as a post tax, but I am showing it separately just for the better clarity, right? So tax expense is how much? Interest amount into my tax rate, 200. So 200 will now be deducted from my earnings, right? And then additional bonus, incremental management bonus, another adjustment the question has. So we have to give effect to that as well. So 1,000 into my 1%. So 1,000 into my 1%. Why 1,000? Are you able to understand this adjustment?
Savings, increase
So
of profit.
earlier, my profit was after deduction of the interest cost, correct? So I have reduced profit. So on that reduced profit, I was paying 1% management bonus. But now, because interest is clawing back to my P&L, no more expense. So my profit is also getting increased. Yes or no? So because my profit is being increased by how much amount? 1,000 rupees. Had this profit was not, had this interest expense was not recorded, then management bonus would have been computed at this 1,000 profit as well, right? So on this 1,000, 1% additional management bonus I need to compute now, because that is a liability anyway for me. So 1,000 into my 1%, 10 rupees. Now, because additional management bonus I am charging off in my P&L, so additional expense also I will get, yes or no? So additional tax benefit I will enjoy on this additional expense. So 10 rupees into my 20%, 2 rupees. So earnings for the purpose of diluted earning per share, 64,792. Now my question to all of you, whatever these entries or adjustments we are doing here for the purpose of calculation of diluted earning per share, are you going to pass on these journal entries as well in your financial statements?
No. No.
No. We are not doing accounting under Ind AS 33 at all. Is that very clear to everybody?
Yes, clear.
Right? No journal entries, no adjusting journal entries within the Excel financials, right? No impact in my books of accounts at all. So these are all assumptions that I am taking, that if this happens, then what would be my PNL? If this happens, what would be my PNL? And basis on that would be PNL, what would be the earnings for my equity shareholders divided by the weighted average number of shares, right? So I'm not going to record these additional management bonus as expense in my PNL. I am not going to remove the interest cost from my PNL. So that is all there, and that will continue to be there. It is only for the purpose of calculation of my diluted earning per share, right? So once all these plus minuses are done, I will be arriving at this number 64,792, which is nothing but the earnings for the purpose of calculation of diluted earning per share, that is earnings attributable to equity shareholders. Is that clear?
It's clear, but I got confused with the entities management receives a bonus of 1% before tax. Before you
Okay,
gave the
okay. Understood your query. So let me explain again. You just give me answers to my questions in yes or no. Okay. Management says that the CFO, the CEO, the MD, the top brass of the company will be entitled 1% of overall sales if sales targets are achieved for the year, and the sales targets are say 100 crore. So if 100 crore benchmark in terms of sales is achieved, then 1% of the sales will be awarded as a bonus to the entire marketing directors team. Is that doable action or not on the part of the company?
yes,
Doable. Now, because you are able to correlate that, okay, marketing team is pursuing for sales target, so if we are allowing a bonus to the marketing team, that is digestible, right? Now what if the company says, if we are able to achieve 200 crore of profits, right, then management bonus of 200 crore 1% will be given to the
yes,
management, and there could be a list of people who would be participating in that bonus, right? So I'm not worried about that, who is actually receiving. The only thing is whether this is a expense on the part of the company, yes or no.
yes,
Yes. Now because management has already calculated this bonus on the profit, which was actually a 210 crore, right? So on 210 crore, 1% bonus was already calculated, which comes to 2.1 crore, right?
yes,
Now, because I am coming to calculate the diluted earning per share, and I saw that there are certain convertible instruments. So if they get converted, convertible debentures, if they get converted, there wouldn't be any interest cost in my PNL. So I have added that interest cost, reduce the tax expense, right? So in this case, for the purpose of calculation of earnings per share, can I say that if these debentures are converted, say in the next financial year, this interest cost will actually be saved?
yes, that's right.
So in that case, once that interest cost is actually saved, then the tax expense on that will actually be expense. Then my profits will actually be trued up for this transaction, yes or no?
Yes, that is understood. Yes, right.
Until now it is understood.
Yes,
Now
sir.
because these are already taken transaction, then the bonus, management bonus, will also be calculated on this revised profitability
Okay, yes,
in that case. So because this is the expected transaction to play out in the future, right, and they are certain to be played out in the future, right, but because they have not yet played out, right, so I cannot adjust only the half impact. right? Only of the transaction. So because of this transaction, if there is any other adjustment also getting triggered in my P&L in terms of profitability dependent expenditures, those expenditure will also be trued up for the purpose of calculation of earnings attributable to equity shareholders, right? Because whatever we are doing here, we need to do in the true spirit what the financial position should look like if all these transactions actually taken place.
Yes, because profit before tax has changed because of
Yes,
reduction in interest cost. So we
yes,
have to take the impact of this increase in management bonus also.
correct,
No,
correct,
yeah.
correct, correct. So although I am not going to pass on any journal entries, neither for the interest cost reduction nor for the management bonus increment, right? But in my calculation, earnings attributable to equity shareholders, I have to take effect of all of these items if they are available, right?
Yes, right.
Right. So once I have computed this earnings attributable to equity shareholders, then I will simply divide by which number of weighted average number of shares, the original shares plus the shares which eventually will be issued on this conversion, right? Plus conversion shares,
Yes.
right? So that's how the diluted earning per share will be computed. So this is the concept of diluted earning per share, right? Now, this is the formula. So what we have done, adjusted after tax effects of any dividends, interest, and income or expense items related to dilutive potential ordinary shares, right? So any income or any expense which is getting affected because we are considering the dilutive potential ordinary shares impact. So all those items will also be adjusted. So management bonus is getting impacted because when we save on the interest, my profit is getting changed. And because management bonus is dependent on the profit number, so that is also getting changed, right? So any interest or any income or any expense which is dependent on this adjustment will also be adjusted. Divide by adjusted for the effects of all the dilutive potential ordinary shares, right? So original shares plus potential ordinary shares is equal to the total weighted average number of shares applied by dates on which they are expected to convert it, right? So this is how the diluted earning per share will be calculated. Now, there are 6 important items or steps, I would rather say, which we need to inculcate in order to come up with the correct diluted earning per share. If we don't follow these steps, then it is prone that we will do a mistake in the calculation of DEPS in spite of being clear in the concept, right? So what are these? First of all, identify all potential ordinary shares, right? So whatever is the list of potential ordinary shares, we need to first of all prepare that list. For example, if there are share warrants, then how much share warrants are there? These and what are the conditions? Then if they are convertible debentures, how many classes of convertible debentures are there and what are the conditions? Convertible preference shares, convertible bonds, right? Or any other similar or potential ordinary shares, right? So first of all, we will list all these potential ordinary shares somewhere. Then we will calculate earnings per incremental share, EPIS, for each class of the potential ordinary share. What do you mean by the earnings per incremental share? So as and when we move on to adjust these items one by one, whether after adjustment of this item, my basic earning per share is increasing or decreasing, right? So if it is increasing, what is the change? Or if it is decreasing, what is the change? So that incremental EPIS needs to be computed. Then I will rank the potential ordinary shares from the smallest to the largest EPIS, right? Ascending order. We will rank it. Then we will calculate the basic earning per share from continuing operations or from the total operations if there are no discontinued. Then we will identify dilutive potential ordinary shares based on their effect on the EPS in the order decided above. And then we will calculate the diluted earning per share. So these are the 6 steps, but don't worry, by reading them like this, it looks like don't know what we are, going to do in the numerical, right? But when we do the numerical and you practice 3, 4, 5 numericals, it will be on in your blood automatically. And as and when diluted earning per share question is there, you will automatically be doing this or following these steps, right? So as such, there is nothing complicated here. Just bear with me for some more time. Let's do this question. ABC Limited earned $383.49 million profit after tax. During the year ended 30th June 2010, the weighted average number of shares outstanding during the year was 255.66 million. The following are the details pertaining to the potential ordinary shares as at 30th June 2010. The entity issued. So this is number 1, this is number 2, right? The entity issued convertible debentures which can be converted into 9 million ordinary shares on 30th June 2012. In the event the debentures are not converted, they shall be redeemed on 30th June 2012. The interest on debentures for the year 2010 amounted to rupees how much? 22 million. 22.5 million, right? So either the shares are convertible, and if they are not converted, they are redeemable, right? So that is the nature of these convertible debentures. Either convert or redeem, and the annual interest amount is 22.5 million given in the question. And whenever they are converted, they will be converted into how many shares? 9 million shares, right? Second item, preference shares issued in 2008 are convertible into 12 million ordinary shares at the option of the preference shareholders. The conversion option is exercisable on 30th June 2013. The dividend paid on the preference shares during the year 2010 are amounted 7.35 million, right? So this is the dividend amount on preference shares, and preference shares are convertible into 12 million ordinary shares. So debentures into 9 million ordinary shares, preference shares into 12 million ordinary shares, interest on debentures 22.5 million, preference shareholders dividend is 7.35 million, right? So these are the crisp facts. ABC Limited options carrying the right to acquire 4.5 million ordinary shares of the company on or after 30th June 2010 at a strike price of 9.9 per share. So they have also issued what? Options to certain investors. So certain investors are having a options contract in their hand, and if they exercise those options, then they can demand the company to issue them how many shares? 4.5 million shares, right, at a strike price of 9.9, right? During the year 2010, the average market price share of the company is $11. So each share is fair valued at 11, and option contract holders have the right to purchase at 9.9 instead of 11. The company is subject to the income tax rate of 30%. Calculate the basic and the diluted earning per share for ABC Limited for the year ended 2010. Right? So all in all, how many contracts we have? Items we have 3 items, right?
3.
Which we need to talk about, right? First is the convertible bonds, second is the convertible preference shares, and third is the options, right? So how we are going to solve this? So first of all, we will start with the basic earning per share. So basic earning per share, for the purpose of basic earning per share, what is the profit given in the question? 383,490,000, right? So this is already given. Here it is. Clear?
Yes, after tax.
After tax. Then weighted average number of ordinary shares also given in the question 255 66. Here it is 255 66 million, right? And the question says weighted average number of shares, right? Outstanding. So this is the weighted average number of shares outstanding, right? So 255 66. So what would be my basic earning per share? Simple. Earnings divided by outstanding weighted average number of shares. 1.5. Clear?
Yes.
This portion is clear. There is no complexity at all.
Yes,
right?
this is simple. Yes.
Now we need to calculate the diluted earning per share, right? So in the 10 marks question, we have already secured how many? 2 marks until now by doing this, right?
I thought
So
1
8
mark.
marks, 8 marks work is still left, right?
I thought 1 mark we have achieved.
It depends on the examiner mood as well, right? Now, profit after taxation 383, 490, 700 plus 73, 500, right? Weighted average number of ordinary shares, this much, and diluted earning per share, this. So this would be your main presentation, right? Now, how this is calculated and how this is calculated will form part in the working notes, right? Because presentation also matters in the examination, right? As well as in the practical life, right? So we can't mess up our solution, right? So this would be your presentation, that this is the basic earning per share and this is the diluted earning per share. Now we will see how all these adjustments are taking effect. So these are the working notes, and because we know that we need to do the ranking in the order of dilution, right? So ranking would be ascending, right? That's what we have studied here, right? Rank the potential ordinary shares from smallest to largest. That is means ascending order. Correct? So
Yes.
now we will do the ranking. Convertible debentures, if converted into the equity shares, how much interest it will be saving? 15.15750,000. How that is arrived? 22.5 million is the interest amount and post-tax impact 1 minus 0.3, so 0.7. Correct? So 222.5 million into my 0.7. Whether this amount is equivalent to this?
Yes.
Right? And how the 22.5 is arrived? That is anyway given in the question. Here it is. Right? So 22.5 million interest saved because the debentures are getting converted into the equity shares, and on equity shares, interest will no more be there. So 22.5 million saved will result into increase in earnings by the post-tax impact. Post-tax means 30% is the tax rate given in the question. So 100 minus 30%, right? So 70%. So 22.5 million into my 70%. So 15,750, right? So this would be the net saving in my earnings. So earnings will increase by this amount. Clear for equity shareholders?
Clear.
Clear. Then how many number will be increased in the weighted average number of shares? How many new equity shares are getting issued by virtue of conversion? 9 million given in the question.
Yes.
Yes or no?
Yes.
9 million. Here it is.
It's given. Yes.
Right? 9 million. Right? So what is my EPIS? 15,750 000 divided by 9,000 1.75. Clear? Then same exercise I will perform for convertible preference shares. So what would be the dividend saved? 7.35 million given in the question. Here it is 7.35 million. Right?
Yes.
Now, preference dividend. Any tax adjustment happens on preference dividend? No.
No.
Preference dividend tax adjustment? Not there, because preference dividend is a dividend, not a expense, right? So no tax adjustment. And how many new additional convertible equity shares will be issued? 12 million given in the
12 million.
question. So 7.35 million divided by 12 million, 0.61. Clear?
Clear.
Until now? Perfect.
Yes.
Then the third item is the options. For options, are we paying any interest or dividend as of now?
No.
No. So no impact on earnings. Clear? Because there is nothing which the company is paying to the option holders, neither the interest nor the dividend, right? So no impact, zero. But because options are getting converted into the equity shares, so equity shares will be issued, yes or no?
Yes, they will be issued. Yes.
So because equity shares will be issued, so there would be an increase in the ordinary shares, yes or no?
Yes.
Yes. How many those shares would be? So,
But there is an option. There is a right, but no obligation. Maybe they will not convert. They will not convert to the shares.
sorry, be louder.
In the options, there is a right, but no obligation. So they may not convert in
So,
that case.
sorry,
Still, we have
okay,
to show.
okay. I'm giving you a answer. You have the option to ask the management of Tata company to give you the shares, and the right sits with you, right? In case you want to exercise this option, you can go and ask the company that, boss, I have the options, I have the right to ask you to issue the shares to me, right, at 9.90 per share, and I am exercising this right. Can company deny to issue the shares?
No. Company cannot deny.
Company
But
cannot deny.
the person who has the right, he may not opt to exercise.
So understood. So the person who has the right may or may not exercise,
Yes.
right? But for the purpose of calculation of diluted earning per share, am I going to make a call to all these option holders whether you are exercising or whether you are not? No need, right? Because I will safely assume that if the offer is lucrative to them, they will exercise. If the offer is not lucrative, then they will not exercise. Since
Right.
market price is 11 and I'm giving the shares at 9.9 as compared to the 11. So if the option holders exercise, they will receive the shares at 9.9 and they can sell them off at 11 in the market and they can arbitrage.
Yes.
So the chances are option holders will exercise.
Yes.
Right? So in this case, what is happening? No impact on my earnings because I'm not giving any dividends or interest to the option holders anyway.
Yes.
But there would be an additional number of shares if the option holder exercises the right and I issue the shares to them, right?
Okay, so the company assumes that all these options will be converted into shares.
Yes, company will assume that, right?
Okay.
Now, how many shares? So, how many options the company has given? 4.5 million, right? So 4.5 million options into 11 is the price, market price, minus 9.9 is the exercise price. So 11 minus 9.9 into 4.5 million will give you the number of shares at 4,50,000. That is the represents equivalent increase in the number of shares, right? Now, in my working here, I will add 4,50,000 here and earnings ranking is 0 because there is no impact on my earnings. So, who is the smallest?
I did not understand this 4.5 million became 4,50,000. How?
So, 4.5 million is the number of options, correct?
Okay, it is number of options. Okay.
It is the number of options.
Because in the question it is written to acquire 4.5 million ordinary shares.
Right. So 4.5 million ordinary shares will be offered against the option. So it means 4.5 million will be the options number. against each option, each share will be given. So one option carries one share. So 4.5 million options carries 4.5 million shares.
Yes.
Right? So that's why standard question says AB issued options carrying the right to acquire 4.5 million ordinary shares. So options means one option is carrying the right to one share. So 4.5 million shares will be issued against these options, right? So 4.5 million shares will eventually be issued, right, into 11 minus 9.9. Right?
This I did not get.
What did you, what is the
Four,
doubt?
4,95,000, sir. 11 minus 9.9, 1.1 into 4.5. That is 4,95,000.
4.5 into my 1.1. How much?
4,95,000.
4 lakh 95.
Yes, sir.
4.5, it is 4.5 million,
Huh.
right? So 4.95, you are saying million, right? Correct? This is
Yeah.
4.5 million.
So 49 lakh 50,000 shares.
49 lakh 50,000, right? So 4.95, right? Yes or no? Now you deduct 4.5 from it. How much it will be? 4 lakh 50,000. So 4.5 lakh, 4 lakh 50,000 are the actual shares which will be eventually given for a free, because I am taking 9.9 cash, right? So certain shares are anyway paid, but certain shares are free. So how many shares are free? Only 4.5 lakh shares, 4 lakh 50,000 shares. Clear?
Shares are increasing only for like 50,000.
So no. Understand. How many shares are getting issued? 4 lakh 50,000 shares are getting issued for a free. Yes or no? Because 9.9 to anyway exercising, na? I am receiving the exercise price. So 11 is the fair value. So there were two options. I could have issued the shares at full value, right? 11. Or I am issuing the shares for a free, right? So if I am issuing the shares for a free, then it will result into increase in ordinary shares without an impact on the earnings, right? But here what is happening? I am issuing the shares at 9.9, right, against 11 fair value. So how much is the difference? 1.1,
Yes.
which is the benefit actually being passed on to the option holder. So this 1.1 per share benefit passed on to the 4.5 million shareholders or 4.5 million shares will result into 4.5 lakh shares issued for a free. So what is the equivalent value? So equivalent value is 4.5 lakh shares.
1.1 multiplied by 4.5 million comes to 49 lakh 50,000. Then
49 lakh 50,000
you
minus
said
45. Minus 45 lakhs.
minus 45 lakh. And what is this 45 lakh?
45 lakh is the shares which are issued, at par. So 4.5 lakh is the delta number of shares which are actually getting offered for a free,
Okay.
right? So
Right.
4.4 lakh 50,000 are the shares which are being offered for a nothing to the option
So we have
holders,
to take
right?
only 4 lakh 50,000. That means which
Of
are
course,
free.
because the remaining shares are anyway issued at a full.
Okay. But the
right?
number of equity, otherwise the equity shares will increase by 4.5 million.
Hold on your thoughts. So how much is the number of shares increased here? 4,50,000 with this calculation, and
Yes, with this calculation.
impact on earning is 0. So impact of 1.75, impact of 0.61, and impact of 0. Which one is the smallest?
0.
Rank 1, next best, rank 2, and the highest, rank 3. Correct?
Correct.
Until now, it is clear.
Yes, this
Now,
is clear here.
right? So, in the order of this rank, I will start calculating the diluted earning per share. So, rank 1 for the options first. So, what are my profits attributable to equity shareholders? 383, 490, 000. And what are my number of shares? 255, 666, 000 plus 450,000, right? So earning per share is 1.5, right? And effect is nil. Then convertible preference shares. Again, this is earning, this is the dividend saved, this is the additional shares, right? So 1.497 will be the dilutive earning per share, because 1.5 is higher and 1.497 is lower. So my basic earning per share is falling. So if basic earning per share is falling, it means it is a dilutive, right? Then for the convertible debentures, 3.9840 plus 15.750, 9 lakh. And again, my earning per share is getting reduced from 1.497 to 1.458. So it is again dilutive, right?
So here we have to see from 1.497, the drop from 1.497, not from 1.5.
So that's why we have ranked all these items. So rank 1, rank 2, rank 3. So we'll start with the rank 1 because it has most effect, then rank 2, then rank 3. And in this order, we will reach to a stage where dilution will no more be there, right? So in this case, after considering this, 277 would be my ordinary shares and 406, 590, 000 would be my earnings attributable to equity shareholders. And the number comes now 1.467. So 67 is higher than 58, right? So it is increasing. So it is becoming anti-dilutive now, right? So we will ignore this and we will say my diluted earning per share is how much?
1.458.
1.458, right? So this is how I'm going to present that my diluted earning per share is 1.458, because basis, if we don't do this ranking, then what will happen? We may end up in mistaking in the diluted earning per share calculation, because diluted earning per share continues from top to bottom, right? And as soon as any instrument is showing up as increase, then that instrument is ignored for the purpose of diluted earning per share, right? So since diluted earning per share increases on taking effect of the convertible preference shares into the consideration, that is the EPS increases from 1.458 to 1.467, the convertible debentures are considered to be anti-dilutive and therefore needs to be ignored for the purpose of calculation of diluted earning per share.
If there is some other instrument and again after anti-dilutive, that becomes dilutive. So we will have to take that.
Yes. So any dilutive instruments will be considered, any in anti-dilutive will be ignored. And your question will not be there if you are doing the ranking properly.
Okay. Yes.
Right?
Right. Yes.
Right. So that was the concept of diluted, but we will do few more numericals and we will discuss again the diluted earning per share concept in detail, right, in our next session. So since the time is over, so we are stopping here and we will continue in the next session. Please come with some sort of practice on these numericals from your textbooks. That is a basic expectation I am having for the next session from you.
Right. Okay.
Thank you, sir. Sir, I would also like to address our students and say a few words. Students, since we are going through this India 33, this is an important topic, and mostly 8 to 6 marks, 6 to 8 marks questions are asked on this particular topic, and students generally face problem in case of anti-dilutive and dilutive progression only. So, what today sir has taught or covered in his session, you have to revise that because it is important and students question may be asked on this potential dilution wala question. Okay,
Correct.
so one more thing, students, just fill the feedback form, and also in case you have any query or something, you can ask us over the WhatsApp also and here also. Along with that, today we are going to have a fortnight program which is addressing January 2026 students, those who are going to appear in January 2026. This is in enhancement of BOS for success, which we conduct after mock test papers. So those students who want to are interested, they can appear, they can join this. At the session will be from 3 to 5 virtual, 3 p.m. to 5 p.m. And when you log into the BOS knowledge portal, you will find a pop-up for this uh, program. Okay, so please do join, and you will get benefit how to prepare for the examination. What are the doubts you are having? Technical, you can raise it through Google Form, or you can also ask me during that time. I'll be available for that program also. Okay, thank you everyone. Any
Okay.
query
Thank
you
you very
have,
much.
you may ask. Yeah, Sanjay, tell me.
Yes, I see. Thanks. Thanks a lot. So
Okay.
I'm appearing for May. Can I join that?
Definitely, you
That is
can join. It is not, see, for January 26 we are targeting, but your what we'll be sharing is that in general basic tips. Along with that, any technical queries which students have asked, whatever students are facing problem in any particular standards that they'll be asking, and we'll be trying to cover that through our expert faculty. I'll be there along with me. There'll be one expert faculty who will be responding you for all your technical queries. Okay. So you
okay.
can you can also, those who are going to appear for May 26, they can also join. Flyer was also sent on the WhatsApp group. Through that, you will find the link to join that program. Any other query? Vibhu, Neha, Leela, Sanjay, any other query? Manish? So in case you don't have query, then
No,
we'll
ma'am.
wind up the session. Huh? Manish, you were
No,
saying something?
no, ma'am. No queries. Thank you.
Okay. All the best then, beta. Huh? Okay. Bye, everyone.
Good day. Thank you.
Good day. Good day. Thank you. Bye.